When investing in the stock market, it is crucial that you make the right choices and deploy your hard-earned money wisely. Here's what you can do before investing. Investors can uncover some pretty good opportunities by delving deeper into the details. This allows you to identify stocks that are trading at a low value but are well poised for robust growth. When you enter such stocks at the right time, you can realize some significant profits from your investments over your investment horizon. There are two ways of analyzing stocks. Fundamental analysis. This method assumes that the stock's current value is not the actual value. In this method, investors use various tools to arrive at valuations that help them determine whether the stock is overpriced or underpriced. This method identifies long-term investments. Technical analysis. This method assumes that the stock price correctly indicates the company's value. In this method, investors look at the historical price movement and try to identify trends that may help them ascertain how it'll move in the future. This method identifies short-term investment options. Here are some things to look for when scrutinizing the company's financial documents for fundamental analysis. Stability of the business, consistency in cash flow, historical revenue, profitability growth, year-on-year and quarter-on-quarter. Compare these factors with other companies in the same sector to determine whether it is performing better or worse than its peers. If it performs better, it will likely continue to do so as it adds value to its consumers. This strategy is called value investing. It is beneficial for all investors if they learn how to interpret companies' financial statements. Here are three basic metrics you need to dive into. Price to earnings ratio, P by E. This is obtained by dividing the price per share by the earnings per share. A lower P by E ratio among peers indicates a cheaper buy. Price to earnings growth ratio, PEG. This is calculated by dividing a company's P by E ratio by its annual earnings growth rate. The PEG ratio usually verifies that a fast-growing company is invariably available at a lucrative price. Debt to EBITDA ratio. Take the company's debt available on its balance sheet and divide it by the EBITDA available in the income statement. A company with higher debt to EBITDA exposes you to greater investment risk. Technical analysis is a better indicator when used alongside fundamental analysis. This is because it relies solely on historical data and identifies patterns on the price charts. It is extensively used in the commodities and forex markets, where short-term volatility can generate gains. Here are a few things tracked by technical analysis. Price movements, patterns appearing on the price charts, trading volume, moving averages, resistance and support levels. The correct answer is both in conjunction. Always go after long-term investments and use technicals to back your rationale. Equities are always rewarding in the long term.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.